Well, hey there, everyone. Happy Tuesday, April 21st, and welcome to Chart This with Dave Keller. Good to be with you here live on Tuesday, April 21st. We are live streaming currently on YouTube, X, Facebook, and LinkedIn. We had some issues with the YouTube stream yesterday, so hopefully we're coming through okay. If you guys on the YouTube wouldn't mind dropping me a quick "I can hear you" in the chat, that would be helpful for me to troubleshoot whatever was going on during the live stream. Of course, if you are tuning in live, you are welcome to ask questions all along the way. Just drop a comment on any of those platforms wherever you have the opportunity to do so. I can see those here on the live stream platform I'm using, and should be able to answer a question or two as we go. If you're watching the replay later on our YouTube channel, hey, thanks for tuning in. I appreciate it. Hope this show helps you navigate the markets and make sense of what we saw today. And check out, and please drop a question there, by the way. We're going to be doing an all mailbag episode later this week. Have to adjust the schedule a little bit for the show. I'm actually traveling to Northern Michigan to visit my daughter. She's at Interlochen Arts Academy. They've got an orchestra concert. She's got a recital. I'm going. So I am going to be traveling on Thursday and Friday, but I'll do my best to see when I can fit in some great content to share with you. So keep your eyes peeled on my YouTube channel. I'll try to keep you updated through social media if we have to adjust things. But thanks so much, all of you, for joining in. Kind of a choppy day here, but net fairly negative for stocks. You're going to find only two of the S&P sectors finished in the green, and only one of them actually finished meaningfully higher, and that was the energy sector. As we talk about the market update today, all the major indexes in the red. The only thing not in the red is the VIX, which earlier in the day actually was above 20, which is that kind of basic line in the sand that we like to keep an eye on. VIX below 20 is a low volatility environment. I would say, given where we finished, we can still consider the market in that particular configuration. VIX above 20 is where you have to start thinking about the dangers of what a high volatility environment means. It really simply implies big swings, right, in any direction, right, to the upside or the downside. But markets usually don't see an injection of volatility during a constructive market environment. That usually implies elevated uncertainty, which usually means the market's going a little more risk off. So we were watching that 20 level earlier. By the close, we're back below 20. That's great news. But let's keep a watchful eye on there as the week progresses and as we get more and more earnings data to parse and digest and discuss. There's the chart of the S&P. We can see a fairly decent open. First 30 minutes was pretty constructive, but then a series of downward legs and a number of big ones right around 10:30 a.m. Eastern, right around 3:30 p.m. Eastern, really sort of solidified the negativity to today's session. The S&P 500 down about 0.2% to close around 70.64. About the same, right? Look at the Dow, the S&P, and the NASDAQ, almost identical percent changes. So that tells you it wasn't a really meaningful theme in terms of styles, right? It wasn't like growth versus value or offense versus defense necessarily is implied, at least by those returns. This was more of a everything generally lower type of tape. Again, at this point, we'll talk a little bit more about technology a little bit later because that did outperform the benchmarks. But again, basically flat for the day. Same thing when you think about cap tiers, right? Mid caps, small caps, we were all down right around the same percent. So some days we get a very clear message, large over small, growth over value, something like that. I would say this is one of those days where that's not really it. This was just a generally retracement day across the board. Most indexes, which were quite strong going into the end of last week, after yesterday's kind of yawner of a session, today kind of going a bit risk off here. We're still not too far off of all-time highs with a lot of those charts, but worth noting this was a day where we did not indeed go higher. The VIX, of course, we'll talk about a little later. I did grab a chart of the VIX just to show you VIX spikes above 20 usually aren't a great sign, and that's something we want to keep a watchful eye on here. Bonds generally moved lower along with stocks. So we can see the TLT, which is a bond ETF, a treasury bond ETF, finished near the lows of the day, down just over 0.5%. Rates generally moved higher. So the 10-year yield finished today right around 4.3%, and the long bond yield around 4.9%, right? So the 10-year yield down up to 4.3%. We were down to 4.25% at yesterday's close. So bonds selling off a bit today. Rates going higher, the dollar going higher as well. and finished near the highs of the day. So I think the acceleration through the course of the day tells you a lot about the sentiment today and what today meant. A risk-off move, besides stocks moving lower, you probably see volatility go up. We probably see rates go up, and we probably see the dollar go higher. And those are the three things we generally observe today. I actually had a great interview earlier today with Chris Vermeulen, founder of the Technical Traders. He's based outside of Toronto in Ontario. That episode should be out to you later this week. Really interesting conversation. Great sort of timeless thoughts about how to approach the markets in a period of uncertainty. So I think there's going to be a lot of great nuggets for you to experience. However, I asked him at the very end, what's the one chart you think is most important to just sort of determine if and when this market starts to turn south, speaking of the equity space? And his answer, the US dollar. He was saying not just the daily movements in the dollar, but look at the weekly chart of the dollar, which, hey, it's my show, so we're going to do that right now. If you look at the weekly chart of the dollar, the daily chart has been kind of noisy in 2026. Here's what that looks like. It's on stock charts, by the way. If you use the stock charts platform, $USD. On other platforms that I've used, it has a ticker like DXY, but also has other tickers on other platforms. So, check out any good charting platform will have a dollar index of some sort. It's just the tickers are not consistent because it's not a tradable security. So just dig around a little bit and you can find a US dollar or ideally a trade weighted dollar is what you're kind of looking for. So the daily chart has been sideways, right? For the last 12 months, we're exactly where we were in mid-April of 2025. I'll say it again. Over the last 12 months, the dollar has gone nowhere. It's fluctuated, right? It's drifted up and drifted lower, but generally the dollar index is flat. And I think the weekly chart, looking at the last 7 years, is where you can see that sideways trend. Remember, markets can trend in one of three directions at any time. We can be in an uptrend of higher highs and higher lows. We can be in a downtrend of lower lows and lower highs, or we can be in a sideways trend of relatively stable highs and lows. And I would argue the dollar index has been in a sideways trend. When the dollar index has gotten down around 96, 96.50, we've seen upside reversals in the USD. When the dollar has gotten up to that, what we call the parity level of 100, we've rarely gotten much above there before the dollar starts to rotate lower. So in April, we actually rotated up to that $100 or 100 level. It's not $100, but 100 points basically. We drifted up to that 100 level in February and basically stalled out there in March. April has been a risk on the move for stocks, right? Markets have been going higher and the dollar index has been drifting lower. So his point is, look for the dollar. And if you see the dollar rotate back up toward that parity level on the daily chart, that tells you we're in a bit of a pullback. If we start to see this big sideways trend turn into a big accumulation phase or a primary uptrend in the dollar, that's when a big sort of sell-off in the equity space is most likely happening. The dollar and the markets can go up together, but what's much more common, given the current conditions, a spike in the dollar would be implying a lack of confidence in equities and other risk assets. So interesting, given that conversation, I thought it'd be interesting to dig into the dollar there a little bit. So the dollar finishing near the highs of the day, maybe heading back toward that parity level, certainly something to watch. Commodities did very well or very, very poorly, depending on which area of the commodity space we're talking about. We're talking about crude oil. And again, this is tied, of course, to the headlines coming out of the Middle East. The ceasefire is happening. No, it's not. The Strait of Hormuz is open. No, it's not. Yeah, it is. No, it isn't. Ships are getting through. They're fine. No ships are getting through. I mean, the headlines are sort of all over the place. I feel like it's a fire hose of differing data coming through from different sources. Having said that, what is the market telling us in terms of general optimism or pessimism? Well, the markets are telling us crude oil prices are going up. That implies that given the net result of all of those headlines that we saw today, pressure on the supply of crude oil, and that's causing prices to go up. So the USO finished up almost 6% today. Precious metals, which have been much more closely tied to equities, all drifting lower today. So you can see the GLD down 2.8%. You can see silver down 5%. Copper prices, not a precious metal, but more of an industrial metal, down as well. So the energy side of the commodity space, pretty good. The metal side of the commodity space, not so good. Ag kind of in the middle, and some interesting charts in there to be certain. But precious metals continue to have a fairly strong correlation to the equity markets. Cryptocurrencies rotating lower a little bit here over the last 12 hours or so. You can see Bitcoin got above almost to 77,000 earlier today, but through the course of the equity session, kind of drifting lower. Bitcoin currently just slightly below where we were at the end of yesterday's 24-hour session. We're currently sitting right around 75,650. Ether prices also flat for the day, but just sitting right above 2310. And so we can see kind of mixed results right now in the cryptocurrency space. Cryptocurrencies are interesting to watch, number one, as a potential investment vehicle. I love the fact that there is a new market that has emerged with fairly liquid ETFs that gives us the opportunity to access that market. I think that's generally a good thing for individual investors. I like having different options. And also, I would argue, given the lack of fundamental data backing up the cryptocurrency market, it's really more driven by free speculative forces. Are people adding risk or subtracting risk? Are they taking a shot at Bitcoin or not, as well as Ethereum and others that you see on here? For now, kind of unknown, right? Kind of, Bitcoin spiked up to 75,000, got a couple thousands above there, and now has been kind of chopping around. Sitting above 75,000, I think, is still a pretty good chart. For now, holding its recent gains. All right, let's look at the 11 S&P 500 sectors. And I would say it's worth noting today that the sector action was not great. We can see that basically 9 out of the 11 sectors finished in the red. Only one of them was flat for the day, and that's technology, less than 0.1% away from yesterday's close. Energy, the only sector moving higher. This is a similar vibe to what we saw earlier in the conflict in the Middle East, as things were just starting to get, hostilities were starting to escalate. We're starting to think about potential market impact. And we would have these days where most stocks were down, where the benchmarks were down, but energy was up, because the spike in crude oil prices is enough to drive energy stocks higher, right? Energy stocks generally, and again, there's some different types of names and different types of companies, from sort of upstream to downstream and everywhere in between. However, generally, the XLE, weighted to a bunch of integrated companies, a bunch of E&P companies, that stands for exploration and production, generally tied to crude oil prices. So crude oil prices are stronger. Energy as a sector generally does tend to do better. So with oil prices higher, with a conflict in the Middle East once again feeling like maybe an uh-oh moment, we'll see what happens with the latest deadline and potential peace talks. Crude oil prices going higher is making the XLE go up. So without that, this is a pretty ugly day for stocks. So worth noting that technology did finish just above the zero level. Again, while the benchmarks were down, technology not down. So that's good. That means technology remaining a relative outperformer. If you look at the stocks, different sectors in the month of April, very few of them outperforming, and none of them outperforming to the degree that technology certainly has been. Financials and consumer staples, number 3 and number 4 on the list there. On the bottom of the list, you've got a couple defensive sectors. Real estate down almost 2% today. Utilities down almost 1.8%. REITs and UTs are two of the more defensive sectors out there, right? These are tending to be lower volatility sectors, tending to be a higher income, higher dividend payers. So these are great places that institutions like to ride out periods of market uncertainties. The fact that we're not seeing a wholesale drift into defensive sectors, I would say, means there's not a lot of red flags in terms of sector positioning just yet. But I would definitely be watching those defensive sectors, which is why I have a chart just looking at the 4 defensive sectors to see if we get a rotation higher. Industrials also down 1.4%. The reason why that's not a feel good is because there's a bunch of earnings in the industrial sector. So the ideal situation, if you're all bulled up right now, is that earnings remain strong, is that there's a great bid out for industrials and others that are beating earnings. We're not necessarily seeing that dynamic play out here today. All right, that's the sector action. Looking at the individual stock breadth, also not great. We can see on the New York Stock Exchange, one of the worst breadth days we've seen in quite some time, actually. 71% of the NYSE names were down versus 28% higher. That sort of negative breadth was pretty consistent across cap tiers. If you're looking at the S&P, you're looking at the NASDAQ, you're looking at the small cap space, all kind of similar, 65 to 71% decliners. And so that means about a 2-to-1 ratio of stocks going down versus stocks going up. Breadth has been pretty good overall in April, right? We've seen a lot of stocks starting to do better. not the story here today. All right, looking at the Magnificent Seven and Friends, this leading group of leading growth names, very much a mixed bag. So let's celebrate some of the names that were actually managing to go up on a day when the benchmarks were down. Three stand out to me. Microsoft up 1.5%. Amazon and Broadcom both up about 0.2%. On the downside, we've got two of these names down over 2%, led by Apple. We had the news that Tim Cook was resigning that we processed yesterday. So the stock down about 2.5% in the first trading session after that. After that announcement, Netflix, after talking about Reed Hastings leaving, that was earlier this month, down 2.4%. So far, the vibe I'm getting are sort of those big time tech CEOs and communication CEOs leaving their companies. Not an instant great reaction to that general trend. We'll see. It's still early days, and there's a lot of other things weighing on these names, I'm sure. But both of those names pushing lower. Alphabet and Tesla actually both moving to the downside as well. All right, I think that's it for the market recap. Let's look at the heat map and just check in briefly with some of the trends here. We are live streaming on YouTube, X, Facebook, and LinkedIn. I thank you guys so much for tuning in live. It looks like we're coming in strong on each of those platforms, which is awesome. Please take a moment if you're watching live, drop a question in the chat on any of those platforms. I can see some great questions coming in already. We'll try to get to one or two here today, but any of them that we don't get to, we'll put in the mailbag. And later this week, hopefully we'll take a little bit more time to answer some of those some great questions here. Looking at the heat map, I mean, not a great day, right? And we can see that just immediately. And this is what I love about the heat map. If you didn't know what the S&P had done today, if you didn't know what the breadth data specifically had said, what's your feeling looking at this heat map? I mean, pretty clearly not a great day for stocks. Definitely more of a risk-off day, and you can see a lot of red in a lot of different sectors. It's generally, I'm seeing a lot more red or a lot deeper red in some of these value-oriented sectors. What jumps out to me is healthcare with names like Merck down 3.9%. Why is that a problem? Because Merck is making arguably the most classic double top pattern I can come up with. If this plays out and if Merck ends up dropping meaningfully below 112, future books that are written about double top patterns may include this as kind of the textbook example. I mean, if you saw the acceleration toward the end of last year into, let's see, this is January and then February, make a new all-time high just around 124. We pull back to the 50-day moving average, spend a couple weeks there chopping around. Then we get a retest of that previous high, right? So remember, an uptrend, which is what Merck was absolutely in since, essentially last summer, right? Starting in the fall, you get this pretty clear example of higher highs and higher lows. That's what I call an accumulation phase, when investors are buying in on the short-term weakness, when dip buyers are causing that next move higher. That is a healthy bull market phase. And as long as that trend persists, conditions are pretty good. So how does that trend change? How do we determine that accumulation phase is no longer in play? I would argue that we stop making higher highs and higher lows, which means two things need to happen. Number one, we try to make that next new high and we fail, which means dip buyers came in, but not enough accumulation to propel us past the previous peak, which means this trend may be stalling out, right? Look at all these previous signs when we made a new high, and that's the sign that we're heading into a new impulse move to the upside. We didn't get that this time, right? Because we attempted to break above that February peak and we stalled out. The only thing that's left to complete this downside reversal would be a failure to hold the previous swing low, because now all of a sudden we're no longer making new highs and higher lows. We're actually making lower highs and lower lows. And so I would say today, breaking just slightly below that 112 level. We'll see if we get some downside follow through, but we are testing support, potentially breaking it with the RSI pushing just below 40 after remaining above 40 for all during that period, right? That point when I said we started this uptrend, note how the RSI becomes overbought on those rallies. And when we have those pullbacks, the RSI often gets to around 50, rarely gets much below 40. And that's sort of the mark of a bullish phase because there's that positive momentum. Now we're kind of getting the opposite. We're not holding 40 on those pullbacks. So Merck, I would say, potentially completing this double top pattern. I think that chart is more guilty until proven innocent based on what we've seen so far. That's a good example. I'm gonna store that one away to refer back to. Since we started with things that were starting to disappoint, I do want to point out, of course, a lot of charts in the utilities and real estate sectors coming down a bit. Some of these have been pretty good charts. NEE, which is NextEra Energy, we'll bring that up just to show that it's very murky. That is a big time pun. I mean, murky in terms of MRK as the stock, as it's also showing a potential double top pattern, but also murky, as I would say the picture is generally unclear. But again, where these charts start to go from okay to very much not okay is if we break the recent swing low with the RSI pushing below 40. That's another name that is starting to do that. And all that tells you, what that tells you with both of those charts, these were charts that were very good, very strong in the fourth quarter, very strong in Q1, but now just starting to stall out and starting to rotate lower. And I think that's a dangerous rotation we want to be concerned about. In the healthcare sector, as I mentioned, some red, but also in the industrial sector. And the problem I have there is this is where we have a bunch of earnings this week, right? I mean, I think the bull case, as we articulated it to our market misbehavior premium members in our weekly flight plan over the weekend, was, look, the bull scenario from here, you've got a bunch of industrials, a bunch of healthcare reporting earnings. These companies have strong earnings. They have strong results, ideally strong forward-looking numbers, guidance, earnings revisions or estimate revisions from the street. And as a result, the market would reward that optimism by being reflected in stronger stock prices. I'm not getting that feel today, as charts like Raytheon appear to be putting in a lower high and now potentially putting in a lower low. How many of these charts are we going to find, right? Having this very similar pattern. So what concerns me about this market here is not the S&P rotating lower, although that's the way we'd measure it. You know, as a bottom-up analyst, right, putting on my bottom-up hat, which means I'm looking at a bunch of individual stocks and just trying to glean a broader market message. Technology names still look pretty good, but there are a bunch of things like Raytheon that did look really good and that were bouncing in early April that now Raytheon's given back all of that optimism that we had once the ceasefire's announced and kind of things are great again and Raytheon's going back up and we're talking about a retesting previous highs. It's kind of given that back and it's rotating back toward potentially making a new 3-month low. One of the regular scans that I run all the time is stocks making new 3-month highs as an area to find potential new ideas to the long side. Stocks making new 3-month lows. And if I see a bunch of Raytheon and Merck kind of charts popping up on the new 3-month lows list, that would not be bullish, is the way that I would generally describe it. So if those are the areas of the market showing some weakness, and particularly I'm looking at that aerospace defense group, you look at Boeing, GE Aerospace, Raytheon, NOC, that's Northrop Grumman, TransDigm. These are all in that group and all bright red today. There was some sort of earnings news in there that weighed on all of those charts. I would assume it's not great. So what worked? The energy sector, of course, works, right? If you believe that crude oil prices and the move higher today is the beginning of some broader move higher tied to whatever macro reason you want to latch on to today, the energy sector should be a great place to be because these are stocks that all did remarkably well when crude oil prices are going up. They all had meaningful pullbacks here in the last 6 weeks, which means there's a pretty good opportunity to buy in on some short-term weakness. And investors are clearly doing that as charts like ConocoPhillips and Valero and MPC are having nice bounces higher. The other thing I would note, just thinking at a high level, how good does technology look right now? It's not Apple and it's not NVIDIA. It's not some of the semiconductors like LRCX and KLAC. All the names that I just mentioned were down today, but a bunch of stocks were up. Not just that they outperformed, but were up on an absolute basis, right? And it's the storage names like Western Digital and Seagate. How many times have we referred to those charts here recently? And I would say if you're thinking of, since we talked about kind of that double top sort of look, Seagate arguably was doing some sort of double top kind of pattern here. And if this move right here had undercut that peak, it would have absolutely been probably labeled as some sort of double top. I'd probably still label it as a coil pattern or symmetrical triangle pattern because it's not really a precise high. It's more of a lower highs, higher lows. That's how we labeled the chart. And we were just looking to see which way it broke. It broke out at the beginning of this month. And look at how it's just continued to run higher. So this is what we call a gap and run, where we have an upside gap and then buyers come in. That's a fantastic outcome when you have that initial gap higher, because what you don't want is a gap that investors are taking profits. If they're thrilled to cash out, the price most likely goes down. Here we're seeing the opposite. We're seeing investors willing to take on additional risk and bet on further upside potential in Seagate. So I would say charts like Seagate and Western Digital did not make a double top. They actually broke through those previous peaks, and for now continuing to move higher. So again, when you think about sector weightings, it's hard for me to identify a better sector than technology so far in April. That's kind of been the class of this market. That's been the juice. That's been the sector that has had names like Western Digital and Seagate that continue to go higher, despite the fact that macro headwinds are sort of emerging here. All right, that's a take on the heat map. I dug into a couple charts more than I probably expected to. So we'll finish off looking at some charts. Before we do that, though, a couple quick announcements. First off, we do have a webcast coming up tomorrow. A number of you mentioned you signed up. I'm so glad that you did. If you haven't, it is not too late. Go to marketmisbehavior.com/leaders. I like doing these webcasts where we can take a deep breath, take a step back, and think about process, think about how we can improve our goals of identifying opportunities, managing risk, all the other things that we talk about with our Market Misbehavior Premium members. This session is called Follow the Leaders, Relative Strengths, Breakouts, and Better Ideas. You can sign up for that event at marketmisbehavior.com/leaders. I guarantee you will leave, hopefully, with some ideas about how you can make your process a little better starting on Thursday, starting the day after that event. So please sign up. Would look forward to having you join me there. Also want to give a shout out to one of our partners, Seeking Alpha. They have a part of their platform called Alpha Picks. If you're looking for high quality stock ideas, but you don't have the time to dig through thousands of charts and thousands of fundamental reports and earnings data, this is worth a look. Alpha Picks from Seeking Alpha will give you 2 data-driven stock ideas every month. They hand select those names from their top-rated strong buy universe using their proven quant model. It's a simple, systematic way to follow a rules-based approach to stock selection and the added benefits of full transparency into the process behind the picks. You can learn more info about their Alpha Picks product at marketmisbehavior.com/Alpha Picks. If you use my link, you'll get a little better deal than normal, and it helps me make Market Misbehavior awesome. So thanks for checking out their Alpha Picks product, and thanks again to Seeking Alpha, being longtime supporters of Market Misbehavior. All right, let's look at some charts together, shall we, to finish off. Thanks again for some great questions. We'll try to grab some along the way here, and then we'll finish strong on the show. So here's the daily chart of the S&P 500. Here's what the last couple days have looked like. This was Friday's gap higher and stronger close, closing above 7,100 for the first time in history. Here's yesterday's, what we call an inside day, where the range is narrower, lower high, higher low, kind of inside there. And then today we get a bit of a distribution day with the down move. There's not a particular candle pattern that I think this perfectly resembles, but it does give me a 3-day period of an up day, a sideways day, and a down day. So I would describe today's price action as certainly not constructive. This is the biggest down day we've had since that gap higher earlier in April, when we've got the ceasefire, when things are all great, and the S&P starts powering up towards 6,800. So again, this is one day. We're still not that far off of all-time highs. 7,000 is that initial kind of line in the sand. As we shared on yesterday's show, I kind of updated the green lines and the yellow and red shaded areas, what we call our traffic light approach, just to reflect on some of the short-term levels that I think are meaningful. I think anything above 7,000 we can think about as generally noise. I think the trend is still positive until we would change that. We break below 7,000, 6,800 becomes the new level of support using this framework, and that's basically just using the previous pivot point that has served so meaningful. We also have a pretty meaty gap there to think about, from around 66.20 up to 67.50. That's something we would probably start talking about as well as the 200-day moving average. But that's our current idea in terms of the traffic light. Now, given the fact that we've been overbought, and with today's down close, we're coming out of the overbought region. So what does that mean? Probably means we're in store for a bit of a pullback, right? Most likely. We could resume an uptrend tomorrow. There's no reason why we can't, but from a purely technical perspective, overbought for a couple of days and then coming out of the overbought region usually means we're in some sort of short-term pullback scenario. So I updated some of the levels here using a Fibonacci framework, taking the end of March low around 63.17, taking the high from the end of last week around 71.50. 38.2% would basically take us right just below the 21-day EMA, roundabouts the 50-day moving average as well, right around 68.30. So when you think about Fibonacci analysis, that would mean that's a downtrend that should be considered, within the framework of still a pretty constructive chart. Because when we pull back to anywhere above the 38.2% level, that just means it's not a significant drawdown according to that Fibonacci structure. So 6,800 was the level we identified on the previous chart. The 50-day moving average right around there, the 38.2% retracement. So I'm kind of seeing that as a cluster of support. So if we would get some sort of drawdown, I would be looking right about there as an area of potential support, potential buying power reemerging in the market. I'm not saying we're definitely going to go there. I'm just saying, hey, when we start turning lower, I immediately think of downside objectives and where I might want to get interested again if I've taken something off the table. With today's drop, the Dow theory look, and this is the new Dow theory, looking at the equal-weighted S&P and the equal-weighted NASDAQ. I think we actually included this chart on yesterday's show just to show that the equal-weighted NASDAQ has already made a new all-time high. That happened going into this week. The equal-weighted S&P still has not made a new all-time high, and I think that's important to be watching. One thing to observe is we still got plenty of stocks making new 52-week highs. This is on today's session. We had about 10% of the S&P, 50 names out of 505 or so listings in the S&P 500. That made a new 52-week high today. So that's not nothing. And to be honest with you, that's very similar to what we saw through the month of January. We usually averaged about 10% of stocks making a new 52-week high. In February, when a lot of names really surged higher, we got up to as far as 22% of S&P 500 members making a new 52-week high. That's something we had not seen in March. That's something we're starting to see as the month of April continues. So the bear case, I would say, would be those those new highs, that green histogram starts to disappear. If we see those names that had been breaking out start to pull back, that's what it tells you. Again, it's just like looking at the chart of the S&P. It's something that validates maybe this uptrend that we've experienced has stalled out a little bit. The VIX earlier in the day did get above 20. It was just a perfect timing as I was putting out some social media posts. And I mentioned, me watching the VIX above 20 and just thinking about that as an important threshold. Again, I love tools and techniques like this that provide peace of mind. They give you a level to watch. So I don't have to stare at the chart of the VIX every trading day. I would argue staring at the chart of the VIX every day is probably not helpful if my goal is to be more of a longer term position trader and not be overreacting to short-term movements. I'm better off not thinking about the intraday wiggly squigglies and thinking more about how the long-term picture has changed. But one thing I've learned, having gone through a number of bullish and certainly bearish cycles in my career, is the VIX spiking above 20 is one of those great early warning signs that investors, at least somewhere, are starting to get a little bit nervous. Credit spreads widening, volatility increasing. Those are two things that I look for. We're seeing volatility tick higher this week. Is it high enough that I think it's a warning sign? Not yet. Credit spreads widening out a little bit. Is it enough to make any sort of red flag? Absolutely not. But that's why we watch them, because at some point they will provide that signal. I'm going to be there watching that chart. The VIX is holding 20 for now. I think that's pretty good. So worth noting, right? The relationship between the dollar, which is the green series in the top, crude oil, which is the brown series in the middle, and gold, which is the very appropriately colored gold series in the bottom. What's happened is the dollar and crude oil are generally moving together, and gold is moving inversely. Gold is moving closer to stocks. So stocks and gold are kind of moving together, highly correlated. The dollar and crude oil moving together, highly correlated. So what gives? Why is this happening? Because a lot of times you think about the dollar and like crude oil as being more inversely related. No, because crude oil, a spike in crude oil tells you, conditions are getting probably less awesome in the Middle East. Maybe there's a threat to the supply of crude oil, and as a result, crude oil prices start to go higher. And if that's what's happening, the market usually is most likely going to take that as a risk-off sort of signal, which means stocks are probably selling off, gold is probably selling off, and the dollar is going higher. It's what we mentioned earlier, that weekly chart of dollar, right? It's been sideways. We see an increase in the dollar that starts to imply some concern about market conditions. So dollar and crude oil, two charts to watch, both ticking higher today. Is it a big trend reversal? I would argue not yet. Is there a scenario where those lines both start to head higher? There definitely is. And I think that might be a really important chart to watch here. Here's the chart of the GLD, just zoomed up a little bit to show from a technical perspective. Concerning development here as we have rallied up to the 50-day moving average. This candle here, all right, here's your candle quiz of the day. What is that candle 2 days ago? This is on Friday's session. The open and close are almost identical. We have a long upper shadow, zero lower shadow. What is that candle pattern? It's just one candle. It's very close to a shooting star candle. Here's your hint. It's not quite there. And I think the specifics here is the open and close are identical or almost identical. They're very, very close. So open and close are identical. That's hit number one. No lower shadow, long upper shadow. Not seeing any correct answers just yet. That is the Gravestone Doji. Man, I love to quiz on some of these, and I love to do it. And I feel like every time I do it, it's somehow validating. Pouring through hundreds of candle patterns, studying for the CMT exam many years ago. Right, didn't know how many candle charts would be referred to, so I tried to just digest as many as I could. And looking back, that was awesome because now I remember the names of all these patterns. For me, though, the names are not nearly as important as what the pattern represents, right? And I think that's important with technical analysis in general, but especially with candle patterns, right? The open and close near the lows of the day means we opened, we traded higher, but by the close, we're right back where we started. So think of it as like a short-term kind of inverted V type of pattern. So the next couple of days, as expected, given that doji pattern, going lower. Today, obviously, a bit of a drawdown here with the gold space. We did not get a break above the 50-day. That's something we were looking for as an upside validation. We did not get the RSI pushing above 60. That's something we were looking for. So for now, gold looking at best is still a wait and see kind of chart. The gold miners are starting to look not as awesome as well, right? We have a big classic bearish momentum divergence in January and February. We did highlight that on the show. And just to revisit, great signal, higher highs in price, lower peaks in momentum. Now we have another lower high. So over the last couple months, the gold miners, the GDX, lower high, now a lower low, which appears to be confirmed with today's drop back below the 50-day moving average. So still okay, but the charts of gold miners still looking, looking challenged here. The real ugliness would happen if we would break below $80. I'm actually going to set an alert on that one. Boy, hopefully it's not triggered, but because that would mean gold prices and silver prices are probably retracing quite a bit. But a break below 80 would complete a move back below the March low and also finally go back below the 200-day moving average. We've been above the 200-day for almost a year and a half, so that would be a big downside change. Similar to some of the double top patterns we highlighted in names like Merck, I'm concerned about some more double tops, and if not a perfect double top, at least retesting key resistance. Here's the chart of Alphabet pulling back this week after retesting its all-time high in February. Here's Apple pulling back today after retesting the upper end of that coil pattern as we highlighted on yesterday's show. Again, this is one day. I think it's too early to write the entire bullish thesis off on one day, but certainly an emerging theme that we're looking for. Hey, DR Horton, there are some stocks that are gapping higher. The good news is the stock finished up almost 6%. The bad news is it was up a lot more at the open, and during the day we saw selling. So what concerns me about the chart of DR Horton, positive move higher on earnings, that's not a bad thing. Finally getting back above the 200-day moving average after breaking below it about 6 weeks ago. Not a bad thing. Those are both very good things. However, we've now gapped higher into significant resistance around 165 to 167. That's where we topped out in December. That's where we topped out in January. That's where we topped out in February. We're kind of right back there. On top of that, we just sold off through the course of the day today. So investors took that opportunity. Traders took that opportunity of the gap higher to liquidate. So that when stocks beat earnings but trade lower through the day, that speaks to less about, I would argue, maybe a lack of optimism in the stock or the theme. It's more just people are willing, they want to just take bets off, and taking bets off of something that just gapped higher. That's a great way to log in some short-term gains and kind of move on with your life. So getting above 165 to 170, 167, that is, would be a fantastic follow through. Are we seeing that today? We are not. And so I would say that's an underwhelming way of digesting earnings. Another upside gap closing near the lows of the day. Again, UNH Great to see. We talked about the break above the 200-day. We talked about how we've had a number of breaks above the 200-day, and that's been it. We did gap higher today on an earnings beat. That's great. We did close near the lows of the day. So does that imply a lack of staying power, a lack of follow through above those previous highs? I'd really like to see this chart get above 370. The weekly chart starts to look pretty constructive in that condition. But for now, we have to grapple with a stock that gapped higher and closed near the low. So stocks gapping higher, closed near the lows of the day. Stocks showing some double topping patterns. I'm not saying this is the end of the world, but from a bottom-up process, I'm finding a lot of stocks, a lot of great examples of some upside exhaustion. That maybe speaks to some short-term weakness here as the week progresses. All right, I did see some great some great questions coming through, and see what we can answer here. Some questions about the S&P. All right, so we got I'm not sure what that is referring to, so I'm not going to dig into it too much. At 3P Investor, thanks for being a longtime watcher and frequent participant, my friend. You said, is it fair to say gradually software companies are getting the traction after that huge sell-off? I mean, when you think about shifts, right? And what I love to think about is, right, at the end of the week, at the end of the month, this is why I built my process around weekly and monthly, processes. The week is so meaningful. And I always look back and just say, like, what happened last week, right? What surprised me? What did not surprise me? What was encouraging? What was discouraging? What's new? What's kind of reinforcing what we were thinking? And I would say one of the biggest shifts that I've seen in those weekly reviews has been the impressive move in software stocks. I think that in a lot of ways has flown in the face of skepticism that software stocks even have a place in the portfolio, given the fact that AI is taking over the world. Like, why do you need software? AI is kind of getting rid of all of their things. If things are more efficient and easier to incorporate using AI, do we need a bunch of software licenses? Those software stocks have done remarkably well, and I think that's been one of the biggest shifts that we've seen. The technology sector looking as strong as it has in April is not just about the AI trade. I think it's software companies as well. Some other names like the storage names that we talked about, I think that's definitely part of it. Through environments like this, there will always be groups that start to do well, groups that have not been doing well that starts to improve. I think that's why a regular process of looking for stocks kind of making new swing highs and new swing lows pretty helpful. And I think that's meaningful. At J. Ross, 1977, Street not impressed with GE earnings. Yeah, I mentioned earlier, thanks for watching. I mentioned earlier the weakness in the aerospace defense sector. And I sort of thought, yes, probably something earnings related. You're right. And I mentioned a bunch of industrials. GE isn't the only, industrial name. There's a bunch of them reporting this week. And I think, there will be individual stock specific things. This is how I think of earnings season. There will be individual stock specific themes and stories that emerge and narratives. However, it's important to think at the end of the week, like, what were the larger takeaways? And if we're in a situation where a bunch of stocks like GE reported earnings and investors are downgrading their positions, or there's selling pressure that's injected because of that, that's a problem, because I would argue the optimism in this market, as one of my last guests on the podcast, Nick Rach, I think correctly put, it's earnings optimism, right? Earnings estimate revisions have remained fairly strong, right? Companies are saying they're in good shape. So as long as the optimism is there on earnings, the optimism is going to be reflected on the chart. If we don't get that optimism, it's hard to think about how the major benchmarks, the S&P and the NASDAQ, could go meaningfully higher beyond what we've seen so far. I did see some other questions. We don't have time to get to all of them, but we will put the remaining ones in our mailbag. We're planning an all mailbag episode later this week. So please take a moment, if you haven't already. What questions come to your mind? Which stocks and ETFs did we not cover that you'd like to see us cover? What questions do you have about the tools and techniques that we're using or that you're seeing elsewhere? Nothing's out of bounds. We'll try to address as many questions as we can. In the meantime, have an awesome night. Thanks so much for watching. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.